Hi everyone, we are Team 20 and this is our TCA number 2 on Alphabet I's New Frontiers. I am Andrea Me here.
I'm Kevin Turner.
I'm Will Felix.
Brian Balanta.
All right, to get us started, we're going to cover the executive summary. So in 2015, Google completely restructured into Alphabet Inc., a new parent company to separate its core business functions, including like Google Search, Ads, and YouTube, from its experimental projects referred to as other bets, so such as Nest, Verily, and X. This reorganization aimed to foster innovation by granting subsidiaries greater autonomy with dedicated leadership and budgets, while offering increased financial transparency to investors. Modeled after the Berkshire Hathaway by Warren Buffett, Alphabet allowed its founders to step back from daily operations to concentrate on broader strategic goals. However, the shift faced challenges, particularly at Nest, where its top-down approach clashed with Google's collaborative culture. Despite significant investment in research and development, Alphabet's reliance on advertising revenue, which comprised nearly 90% of its total income in 2015, raised questions about the long-term sustainability of its vision for innovation beyond Google. So right on the right side, you can see what Alphabet branches off into. So they have their primary like functions, which was like Google Search, YouTube, Google Maps, Google Play, everything related to Google. And then on the left side, you can see that this is what is like acquired and added to its parent company, so such as Nest, which we all saw on Shark Tank, which was like a video monitoring system. So now to just the strategic issue that Alphabet faces is that they face a lot of challenge in balancing subsidiary autonomy with accountability within its conglomerate structure, all while pushing for innovation and sustainable growth. While the company empowers its other bets to operate with the freedom of startups, it must also ensure fiscal responsibility, cultural alignment, and long-term strategic cohesion. Tensions have emerged regarding how long to sustain unprofitable projects, managing leadership mismatches, and maintaining investor confidence in the face of substantial loss. To address these challenges, Alphabet must refine its internal processes to foster innovation while ensuring operational efficiency, maintain its reputation, and protecting shareholder value. So some of the issues that they faced was that, as you saw in the case, the CEO of like Nest had walked out because he just didn't fit in with the culture as well as Verily, and that caused a lot of internal issues and it brought down morale and created a lack of trust within the company.
Here are some key financial and strategic indicators from Alphabet, which occurred in like 2015, and it's on a quarterly and yearly basis. So the total revenue from Alphabet was 74 billion, and majority of this revenue was created by Google, specifically like their subsidiaries like YouTube, Google Maps, etc. And other bets, which is Alphabet's subsidiary companies that are in their moonshot stages, they only contributed 0.6% of total revenue. And something that I found interesting was the other bets operating loss. As you see, they have a negative loss of 3.57 billion, and the percentage was negative 797%. So that's just something that um, Alphabet has to look into whether they want to continue these moonshot projects, as although currently the projects are not generating like a lot of income, but maybe in the future, if they continue to put capital expenditures, that these revenues can grow and these projects eventually become successful. Mentioning, as I mentioned, capital expenditures, the total capex was 9.92 billion, and Google made up most of this, and other bets had 869 million. Um, so a key takeaway from this is that Google continues to drive profitability and fund innovation as they've been successful for decades, and they have a consistent stream of income primarily from advertising, mobile search engines, and the other bets. As I mentioned before, they are operating a significant loss, but they're still receiving capex, and this signifies long-term investment in future growth areas. And the strategic issue that Alphabet and Google is facing is whether or not they should continue to invest in these open bet companies. So here's a SWOT analysis from Alphabet. Some strengths that I identified was the dominant search engine market share, and they also have a strong like innovation culture as they promote risk taking. And like some moonshot projects that failed, they still offer bonuses to employees as long as they just tried their best and was willing to take risks. And Alphabet also has a high institutional investor confidence, and the 99 composite rating was the highest out of all companies worldwide. Some opportunities that Alphabet has is just the continued growth in YouTube and mobile search, as these two streams of income have been steady over the past decades. Some of their moonshot projects focus on expanding AI and smart tech through DeepMind, Verily, and these programs definitely have opportunity in the future to provide financial growth. And another opportunity these moonshot programs have is due to the restructuring, they have increased autonomy. So this allows these moonshot and subsidiaries to basically just run their business without interference from Alphabet. And they have a lot of diversification among the other bets, Fiber, Nest, and they have a bunch more. So this diversification helps mitigate risk and helps Alphabet tap into just different industries. Some weaknesses that they face is over dependence on advertising, as advertising makes up currently 90% of revenue, and they also have high R&D costs, which also was made up 16.5% of revenue. And another weakness that kind of was caused by the restructuring was the high employee turnover. And then some threats facing the company is just internal conflicts with subsidiaries, and then internal competition between these subsidiaries and business units. And then another threat is a heavy reliance on key segments for revenue, and also larger other large companies like Amazon, Apple, and Microsoft are also doing their own moonshot projects, which is a threat of competition. As you know, these moonshot projects are high risk, high reward, and let's say Amazon has a moonshot project that actually like turns out to be successful. This could put Amazon way past Google and Alphabet.
Here are some of the analysis tools we used. We used the Porter's Five Forces and Pastel analysis. So for the Porter's Five Forces analysis, the competitive rivalry for Alphabet is high due to some of the massive companies like Amazon, Apple, Microsoft, Facebook, and like Facebook slash Meta. They can easily do similar projects like this, especially having bet companies due to their massive capital and just being massive companies in general, which can kind of compete with Alphabet slash like Google and all their stuff. Potential new entries is kind of a excuse me, a low risk due to just Alphabet's large amount of money they have from their ad revenue, and they kind of know when new players are on the field just due because it's hard for other companies to have these moonshot projects without being large and have a lot of money to spend on it. The buyer's power is kind of a moderate to high risk, mostly based on if current users continue to use Alphabet's ad and search engines, which are very popular. So uh, the only reason if users continue to go somewhere else, they would just lose some money there and not be able to spend as much money on their moonshot projects. The substitute is moderate. Really just depends on what other companies have to offer. And a lot of users continue to use their platforms like Google and YouTube. So it's not really something they have to worry about that much. And their supplier risk is relatively low because Alphabet controls most of the moonshot companies directly. so they don't really have to worry about them like looking to go other places. And for the Pestel analysis, for political, they're really domestic regulations and global regulations, just like any business, can be affected, especially if they want to move some of their operations overseas. They just have to kind of regulate with how other countries work. And economic, they're heavily dependent on their ad revenue. Like said in the previous slides, it's almost about 99% of most of their revenue is coming from that. Social, there's a big rise in demand for their smart device products that they're kind of developing, especially with Nest. And there could be a concern with over digitizing things, like making too many smart products and having a home almost feel like a robot in a sense. Technology, obviously, Alphabet and Google and whole is huge tech innovator and continue with tech evolution. And they're always heavy on R&D, producing many different things in like the tech world. Legal, intellectual property, label, and compliance challenges across subsidiaries and environment, Alphabet Sidewalk Labs, and Verily Smart Living, Smart Sustainable Living. Um, some of the alternatives for Alphabet, it would be to limit and streamline bets. Pros of this would be more transparent for investors. Investors wouldn't have to worry about a bunch of companies that are underperforming, and it would focus more on some of their more high potential companies that kind of are generating more revenue and actually continuing to build off of themselves. Also, they wouldn't have to limit their resources per company. They could really pick and choose where they want to put their resources into the better developing companies instead of just sharing the wealth among some underdeveloping ones. And it would improve operation costs and controls. Some cons, they would lose other long-term innovations, like something that might have 10 years to grow. They might have to get rid of due to like underdevelopment, and it might take away vision from the entrepreneurs that own some of the or created some of the companies. If they want to streamline it, they might have to kind of limit some of the ideas that they have. And there's a good example of this, like Boston Dynamics, that they had to sell off due to the kind of a lack of direction with them and them doing a little bit too much with not really producing much, especially selling a robot dog for around 75K. Not many people are really shelling out that kind of money for a robot dog. And uh, yeah, and so the second option would make high potential bet companies independent, which is a little bit of a risky move, but it's definitely an alternative that they could have. Pros of this, Alphabet can hold minority stakes, could raise value and shareholder value, and each company can develop their own culture. A good example of this is Niantic, which kind of spun off of Google, and Niantic's the company that created the mobile game Pokemon Go, which launched in 2016, which has been very, very successful. And now Niantic has kind of grown into becoming its own large company. And also, Waymo is becoming one of those high potential bets that Alphabet could look to become an independent company due to their high operation in Phoenix, San Francisco, Austin, and Los Angeles. And some of the cons of this would be Alphabet will lose direct control of their bet companies, and also be high risk if the company underperforms. Obviously, they're putting a big risk in kind of creating like their own culture for these companies. And if they don't really perform well, they kind of lose a lot out of them. And the third alternative would be improving brand image and reputation. Some of the pros of that: builds trust with users, makes other companies want to work with Alphabet, can produce more revenue for underdeveloping companies on their moonshot sides. And some cons: can take a lot of time to change customer perspective. Rebranding can be expensive. Companies like Apple, that people always constantly go back to, customers resonate with them. It kind of becomes part of a customer and their buying choices. So, especially if a company has a good social media presence, it kind of allows them to get more traction and kind of allows customers to have a image of it and kind of resonate with themselves. So they are continuing to purchase from those brands.
Okay, so Alphabet still relies on ads for 75% of its revenue, which is pretty risky. And at the same time, regulators are watching closely, and most of the other bets don't have a very clear goals or tracking with 75% of the $1 billion planned for investment in 2025. Now that's time to I feel like it's time to refocus when it comes to recommending about 30 billion into AI and 20 billion into cloud and cybersecurity, as well as 10 billion into health tech and 5 billion into performance systems and KPI. Our goal is to reduce ad revenue shares to under 65% by 2028 and grow cloud to 100 billion by 2027, and by the end of next year, all other bets should have KPIs with a dashboard live by quarter two. Each unit should have a clear leadership and compliance teams, which should uh which should report directly to the CFO, as well as these plans should innovate strong, but bring in a strong support long term. And you go to the next slide. Okay. So for the final analysis, to sum it up, Alphabet's structure encourages innovation by giving its units freedom to explore, but that same freedom has to lead with a lack of accountability, especially with the other bets, many of which burn money without clearing returns. The company is also still heavily dependent on ad revenue, which makes up 75% of income. That creates long-term risk, especially with the growing pressure with regulators and investors. And to stay competitive and build trust, Alphabet needs stronger systems to track performance and manage results. And for recommendation, to cut and combine the other bets that are underperforming and don't have a clear path to growth. The company should shift attention to other projects like long-term projects. And we also think that Alphabet should apply performance metrics across all business units. This means every project should have goals that can be tracked along with leadership that's responsible for the results. And on top of that, Alphabet should invest in more high growth areas like AI, Google Cloud, and healthcare. And with those sectors, I feel there'll be good momentum later on.